sector will never repeat in the following bull market. So no matter how attractive real estate stocks may look, no matter how attractive any of those winning sector stocks of the last bull market may look, they will, if one really goes by history, and they will not really be the major winners for the next bull market. You will have to find something else which is probably not really discovered right now. Maybe the budget will have put out one or two of them. I don't know, maybe Ramesh will be in a much better position to speak about such things. What I do is look at the action of people as and when they have acted in the market. We look at who's walking the talk and which sector is really walking its talk. And that is what charts really capture. So we may be able to spot it a little earlier when there is no talk but there's a lot of walk. Maybe we'll spot it a little later where it was unfold. But within various sectors, we do have a lot of winners. Particularly, we will find new mid caps, which are already wannabe sort of large caps. For example, I think one of the stocks which Banabin actually mentioned was with respect to, say, hospitals, as allocation to hospitals, etc. And she said stocks wherein there is a lot of research, or stocks wherein healthcare and these are being concentrated upon, and things like that could actually happen in the future, where you may find out newer areas which are, have things which are already, let's say, $500 million kind of market cap or a $750 million market cap. These are the kind of companies which could then elevate into becoming a $1 billion, $2 billion, $3 billion kind of market cap. And those are the stories that one should really try to find out. And wherever the budget as a kind of trigger or anything subsequent, see, the budget is just one focused event, but then if you really look at it out of 12 months in a year, 7, 8 months in a year, we have some sort of policy announcement or the other. So it's not as though everything is just going to come out of the budget. It's going to be a year-around kind of thing. So I would say, sort of rounding up of the whole view that I have, short term looks to be good. How long this momentum will last is a little debatable, because this is just going to be a play out of those who've been on the sidelines waiting for the events to be out of the way prior to pitching in the money. Medium term is not looking so good, so we are looking for a pullback after a short term rise. So those who are a little more oriented towards a slightly more, let's say, proactive approach should probably consider trying to take some money off the highs when we do reach them, either in March or by early April. And then look to re-enter. Those who are wanting to put money into the market, I would say wait for a dip into the mid-year. Somewhere around May, June is where I would think the market should be ideally placed, where we might see lower index and some amount of fairly decent reaction in stocks which are looking attractive. And then look to play these out across the next 6 months to 8 months towards the end of the year. That is what would be the wrap-up of 2010. In terms of sectors, we'll have to do a lot of digging. There may be newer sectors which could be actually in play, rather than tying ourselves down to the, just the known item. We should keep our minds open for the newer sectors, which may be smaller plays today, but where a lot of gems are indeed available. In terms of stocks, the work is clearly cut out for us. You're not going to get stocks off the shelf. We'll need to do a little bit of digging. You will need to be very friendly with your local neighborhood analyst. Have one or two, maybe other technical analysts who will do the additional digging for you. I think that is what would help us all get through 2010 and the 2011 and 12. Thank you very much.
Thank you so much, Mr. Narayan, for that analysis. When Alok invited me to MC, also very graciously asked me to speak a few words, so I will take that liberty and just speak a few words. I think Mr. Narayan spoke very clearly about the yes but theory that's going on in the market. Yes, the budget is good, but if Europe falls, something can happen. And I'd just like to address that question head on. I think there's a palpable fear. I think more than the budget in India is what's going on in Europe, whether Greece will fall or Great Britain's currency will get devaluated. So I think that is keeping the markets in the range. People just don't know what's happening in that sector. My sense is, I'll give you two historic examples, that sometimes a crisis represents the best opportunity to buy stocks. Let's go back to when our own bull market started in 2003-04, when this fabulous bull market was at, when the index was at 4,000, it went up all the way to 21,000. If you recall, the period before that, the market was fixated on technology. It was always the Infosys, Satyam, Wipros of the world that were the market leaders in the world. And then in 2003-04, Infosys gave a very bad guidance. And the feeling was that if Infosys wouldn't work, the market wouldn't work. If Infosys couldn't lead, the market had no leadership because there was so much disbelief that a Century or a Larsen or a Siemens could lead the market higher. And yet Infosys gave a very, very bad guidance. If you recall back your memory in 2003-04, the market fell when the guidance came. But by the next day, the old economy shares were moving along. And it's a lead they never relinquished. They kept making new highs. Let me give you another global example. Japan had a fabulous 25-year bull market that took it from 1,400 in the index to 40,000 in the index. In 1987, which is almost towards two-thirds of the bull market going on in Japan, we had a great crash in America, which Mr. Narayan would remember very conveniently. It was about 22.7% in a single trading session. All markets across the world, Hong Kong was shut down for 3 days, Korea collapsed, Taiwan collapsed, and Japan, which was the strongest market that time relatively, also collapsed along with the rest of the global markets, because the US that time was the barometer market, and it fell 22.5% on a single trading session. Yet, within the next 2-3 months, Japan recovered and went on to make new highs, because there's inherent strength in the Japanese market. I'm suggesting to you that maybe the time has come in India that over the next few months, the sequence will be played out, that we will see a crisis somewhere in the world, the market will fall, because the knee-jerk reaction for traders will always be when they see bad headlines is to sell. But there is enough smart money waiting on the sidelines that will come and buy. And so finally, this thing we've been talking about for 2-3 years, that India could potentially decouple and continue to go on and break its trading range and perhaps make new highs. The question is, if you believe that, how do you play that thesis out in the market? I think often as fundamental analysts also, and even technical analysts, we make the mistake of looking at the trees and missing the forest. We always tend to look at how the company is doing this quarter, or what have been the sales forecast over this year. And in doing this, we forget that the earth is round. There's a sweep of markets that go around, that great businesses are built over time. It's not like, it's as they say, that Rome was not built in a day, so great businesses are not built in a day. What we have in India is one of those rare confluence of factors that are fundamental and are very important to well-being. We have a government that finally understands that markets have to work, that the government cannot have the command and control of the economy and expect Indians to prosper. So they deregulated taxes, deregulated licensing requirement. So that part is done. The second part is that, as all of us realize, there's a huge demographic boom going on in India. We are a very young nation. And as this nation progresses in terms of size from 50 million middle class to 100 million middle class to maybe even 500 million middle class people, right? The potential is there in the next 20 years, 25 years, which is not that far away. I've already spent 30 years in the market. So another 20, 25 years, India could have 500 million people in the middle class, which is of course more than the European population combined, it's more than the US combined. So it's a staggering market that we are creating in India of middle class. And once that population gets to that trajectory, the economy goes from, say, $1 trillion to $2 trillion, and then to $4 trillion. We know what's going to happen with the data. We know what demand is there for insurance product. We know what demand is there for housing, what demand is there for autos. We're just seeing a small incidence of what's happening in autos, that the global auto industry has collapsed, and yet in China and India, you have to wait to get an auto. China sells more automobiles than America today, which, if you were my MBA student when I was, it was unbelievable that it could ever happen. There used to be a saying in MBA school in America that what is good for General Motors is good for America. It was that simple. Auto was such an important part. It's irrelevant today. The company has become irrelevant, right? But look at what's happening in India and the US. So there's an enormous transition taking place between the West and the East for leadership. And the demographic and the economic center of the world is very surely but slowly still shifting between China and India. So my suggestion is that don't miss the forest for the trees. If you take a longer view of India, you'll find a lot of these stocks cheap. Let me tell you about our own business, the broking business that we are all a part of. I mean, our demat ratios are 1 per 100. Okay, that is, for every 100 people in India, one has a demat account. and out of that I wager to bet you only 25% are really active.